Hey everybody! Welcome to another financial accounting tutorial. So for today's episode, we'll be discussing on receivables. So first, we define the meaning of receivables. Well, receivables are assets that represent contractual rights to receive cash or other asset from another entity. So there are lots of receivables, including accounts receivables, or receivables arising or supported by informal or oral promises to pay, notes receivables that are supported by formal or written promises to pay, such as promissory notes, or loans receivable, or receivables that are supported or arising from loans. Other than that, there are advances, accrued income, deposits, and claims receivable. So today we're going to talk about accounts receivable. So accounts receivable is the money that a company or seller has a right to receive from the entity or buyer whom the company had provided goods and services. So for a non-financial institution, the receivable can be classified in two. First is the trade receivable. Well, trade receivables are amounts billed by a business to its customers when it delivers goods and services to them in the ordinary course of business. For non-trade receivables, these are amounts owed to the company that fall outside of the company's normal course of business. Non-trade receivables, as current assets, are only expected to be realized in cash within 1 year. Trade receivables are classified as current assets only when they are expected to be realized in cash within the normal operating cycle or 1 year, whichever is longer. So what does normal operating cycle mean? Normal operating cycle also known as cash conversion cycle, has importance in classifying current assets and current liabilities. Normal operating cycle is usually 12 months, but there are some businesses that require more than 12 months for them to realize all inventories and recovering cash from trade receivables. Initial measurement. Receivables are initially recognized as fair value plus transaction costs that are directly attributable to the acquisition. A fair value is a price that would be received to sell an asset or paid to transfer a liability. Trade receivables that do not have a significant financing component shall be recognized at transaction price in accordance with the Philippine Financial Reporting Standards 15, or also known as revenue from contracts with customers. So PFRS 15 defines transaction price as the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties. Also, the PFRS 15 allows the non-discounting of the amount of consideration if it is due within 1 year from the date a transfer of the goods and services. So, subsequent measurement. Receivables are subsequently measured at recoverable historical cost or net realizable value. Recoverable historical cost or net realizable value represents the amount of cash expected to be recovered from the contractual cash flows of the receivable. The net realizable value is computed by transaction price minus subsequent repayments of principals and minus reductions for uncollectibility and repayment. So, normally, an entity recognizes trade receivables when the ownership or control of the goods is transferred to the customer. We know this by identifying first the term of sale of contract that the both parties have, agreed upon. So, the term of contract happens when determining the timing of transfer of control over the goods sold. One is the FOB shipping point or the free on board shipping point. This type of term of sale contract means you are free from liability, or the ownership over the goods passes at the point when the seller sent the thing. Another is the FOB destination. Ownership over the goods passes at the point when the thing was already received by the buyer. So another thing to consider is who pays for the freight. The freight charges talks about who should pay for the freight. One is a freight collect, wherein the buyer pays for the freight instead of the seller. Second is freight prepaid, or when the seller pays for the freight instead of the buyer. As a rule, the entity who owns the goods being shipped should pay for the shipping costs. So for FOB shipping point, freight prepaid, and FOB destination, freight collect, there is no need for a significant accounting. So for FOB shipping point, freight prepaid, the seller does not recognize freight out for the freight paid because the buyer is the one who should pay for the shipping costs. Therefore, the buyer reimbursed the freight cost paid by the seller. Next is FOB destination and freight collect. The seller is the one who is supposed to pay for the shipping cost, and the seller will reimburse the shipping cost by decreasing the collection of receivables.
For example, on December 27, 2011, ABC Company received a sale order for a credit sale of goods with selling price of 1,000 pesos. The goods were shipped by ABC on December 31, 2011 and were received by the buyer on January 2, 2012. The related shipping costs amounted to 10 pesos. ABC Company collected the receivable on January 5, 2012. For FOB shipping point freight collect, on December 27, 2011, there would be no entry. On December 31, 2011, a debit to accounts receivable and a credit to sales, both in the amount of 1,000 pesos. This is to record the sale on account. Now on January 2, 2012, there would be no entry as well. On January 5, 2012, a debit to cash on hand and a credit to accounts receivable, both in the amount of 1,000 pesos. This entry is to record the settlement of accounts receivable. For FOB destination and freight prepaid, on December 31, 2011, there would be a debit to prepaid freight and a credit to cash in bank in the amount of 10 pesos. This entry is to record prepayment of freight to the carrier. On January 2, 2012, there would be a debit to accounts receivable and a credit to sales, both in the amount of 1,000 pesos. This is to record the sale on account. Now on January 2, 2012 again, there would be a debit to freight collect and a credit to prepaid freight of 10 pesos to charge prepaid freight to expense. Lastly, on January 5, 2012, a debit to cash on hand and a credit to accounts receivable, both in the amount of 1,000 pesos to record the settlement of accounts receivables. For FOB shipping point freight prepaid, on December 31, 2011, there would be a debit to accounts receivable in the amount of 1,010 pesos, credit to sales in the amount of 1,000 pesos, and a credit to cash in bank in the amount of 10 pesos. This entry is to record sale on account and freight paid on behalf of the buyer. On January 2, 2012, there would be no entry. Now on January 5, 2012, there would be a debit to cash on hand 1,010 pesos and a credit to accounts receivable 1,010 pesos. This is to record the collection of accounts receivable inclusive of reimbursement for the freight paid. The seller does not recognize freight out for the freight paid because the buyer is the one who is supposed to pay for the shipping costs. Accordingly, the buyer shall reimburse the seller the freight cost. This is reflected as an increase in accounts receivable. Alternatively, a reimbursement receivable account may be debited in lieu of accounts receivable, most especially when the freight cost is material. And lastly, for FOB destination freight collect, December 31, 2011 would have no entry, while on January 2, 2012 there would be a debit to accounts receivable in the amount of 990 pesos, a debit to freight out in the amount of 10 pesos, and a credit to sales in the amount of 1,000 pesos. This is to record sale on account and freight accommodated by the buyer. Lastly, on January 5, 2012, there would be a debit to cash on hand 990 pesos and a credit to accounts receivable 990 pesos as well. This is to record collection of accounts receivable net of reimbursement for the freight. The seller debits freight out for the shipping costs paid by the buyer because the seller is the one who is supposed to pay for the shipping costs. The seller will later on reimburse the shipping costs by a decreased collection of receivable.
Next, we discuss on discounts. First is a trade discount. Trade discounts encourages orders in large quantities or encourages bulk buying. Trade discounts are sometimes used to hide true invoice price from competitors. Trade discounts are also outright deductions from the list price in order to determine the invoice price. These discounts, remember, are not recorded in either the books of the buyer or the seller. Next is cash discount. Encourages suppliers to pay at an early date or to pay prompt payments. So cash discounts are deducted from the invoice price, determines the net amount of collectibility within the discount period. Unlike trade discount, Cash discounts may be accounted for separately. So trade discounts are deducted from list price to get the invoice price. Cash discounts are then deducted from invoice price to get the net amount of collectible within discount period. Cash discounts may be accounted in two ways. First is the Philippine Financial Reporting Standard 15 or the traditional GAAP, but we're going to focus on the traditional GAAP. Under the GAAP, cash discounts are discounted using either the gross method or the net method. Under the gross method, amounts are initially recorded at gross amount of cash discounts. The cash discounts are then recorded only when they are taken by the buyer. These cash discounts will be debited to sales discount account. For net methods initially recorded at amounts net of cash discounts. Cash discounts not taken by the buyer are credited to the sales discount forfeited.
For example, an entity sells inventory with a list price of 10,000 pesos on account under credit terms of 20%, 10%, 210, and N30. Note that 20% and 10% pertain to trade discounts, which should be deducted from the list price in determining the invoice price. The 210 means that the buyer is entitled to a 2% cash discount off the invoice price if he pays within the discount period of 10 days. After 10 days, the cash discount expires. The N30, on the other hand, means that the buyer is given a credit period of up to 30 days to settle his account. Failure to pay within 30 days renders the account as past due. Penalty may be charged on past due accounts, or credit may not be extended in the future. For the sale on account under the gross method, there would be a debit to accounts receivable 7,200 pesos and a credit to sales 7,200 pesos as well. The trade discounts are deducted from the list price to determine the invoice price gross of cash discount. Now, under the net method, there would be a debit to accounts receivable 7,056 pesos and a credit to sales 7,056 pesos. The trade discounts and cash discount are deducted from the list price to determine the invoice price net of cash discounts. Assuming that the collection is made within the discount period, under the gross method there would be a debit to cash on hand, 7,056 pesos, a debit to sales discounts, 144 pesos, and a credit to accounts receivable, 7,200 pesos. The sales discounts is computed by multiplying 7,200 by 2%. Under the net method, there would be a debit to cash on hand 7,056 pesos and a credit to accounts receivable 7,056 pesos. Now, assuming that the collection is made beyond the discount period, under the gross method there would be a debit to cash in bank and a credit to accounts receivable both in the amounts of 7,200. Under the net method, there would be a debit to cash on hand 7,200 pesos, credit to sales discount forfeited 144 pesos, and a credit to accounts receivable 7,056 pesos.
So next we tackle on the allowance for doubtful accounts. So what's the significance of it? So the significance is that credit is often given to customers to encourage sales. However, when extending credit, due care should be exercised to balance trade-off between rewards of having increased sales and the risk of loss when customers fail to pay their dues. At each reporting, the recoverable historical cost of receivables should be assessed. When collection on receivable becomes doubtful, an allowance should be provided to write down the receivables to their recoverable values. A basic accounting is that assets should not be recognized at more than recoverable amount. So next is that the resulting allowance is treated as contra asset to accounts receivable when determining the net realizable value. Other terms include allowance for uncollectible accounts, allowance for probable losses of receivables, and allowance for bad debts. Bad debts expense. Bad debts expense is recognized when loss becomes probable and can be measured reliably. There are three methods of estimating doubtful accounts, namely percentage of net credit sales, percentage of receivables, and aging of receivables. First is the percentage of net credit sales, or the single loss rate approach. Bad debts expense is computed by applying a percentage on the net credit sales during the period. Second, percentage of accounts receivables. A certain rate is multiplied by the open accounts at the end of the period in order to get the required allowance balance. The rate is usually determined from past experience of the entity. Lastly is the aging of receivables. The aging of receivables, or the aging of accounts receivables, involves an analysis where the accounts are classified into not due or past due. The allowance is then determined by multiplying the total of each classification by the rate or percent of loss experienced by the entity for each category. Next is accounting for bad debts. So there are two ways. Allowance method, direct write-off method. So first we discuss what is allowance method. Allowance method is provided when collectability of accounts becomes doubtful or questionable. It conforms to the concept of accrual basis of accounting. So to record the entries of bad debt expense, when collectability of accounts becomes doubtful, we have a debit to bad debt expense and a credit to allowance for doubtful accounts. When it becomes certain that the accounts are uncollectible or worthless, they are written off as follows. We have a debit to allowance for doubtful accounts and a credit to accounts receivable. A credit to accounts receivable would likely decrease the amount of receivables the entity is entitled to receive. Next is the direct write-off method. Bad debts expense is directly written off from the balance of accounts receivable only when uncollectibility becomes certain when being worthless. It does not conform to the concept of accrual basis and is usually not acceptable except for micro entities. Entry to the write-off accounts is deemed worthless. So we debit bad debts expense and a credit to accounts receivable. So the entry for accounts previously written off but then recovered is a debit to cash on hand and a credit to gain on recovery of accounts receivable. That's it, everybody. So this ends our discussion on accounts receivable part 1. Don't forget to like and subscribe and leave comments down below. Bye!